Good afternoon, everyone. I hope you're all doing well. So I think everybody joined, but like 3 people left. They will join us, and if they miss something, they can just recatch everything after watching the video from the beginning. So my voice is coming. Is my voice coming? Can you hear me?
Yes.
Yes.
Okay. Okay. Because in the morning we had a problem with the connection. It was very poor, but I think now it's okay. Okay, today we're gonna continue with our lecturing. We're gonna just go directly with the risk itself, because as you see the course, the names like financial institution management, and why there is a need to manage something, but that reason comes from the risk that faces all the financial institutions. They need to manage somehow. So let me just share the screen. Okay. Risk of the financial institution. So from the book, as I told you, it's available in Moodle, but we're gonna start from that book. It's not from the first chapter. We are starting from the chapter 7. So if you will want to go and read it, please refer to the chapter 7. What I believe, the lecture notes that I provide in Moodle, it will not be enough, so you will need to go for book as well. The book is available in the Moodle. So first of all, what is the risk actually the financial institution they face? So first of all, we have to define the risk. So how do we come up with the risk, and what is the risk itself, and what does it include actually? Why it is important for the financial institution to take into consideration while making any evaluation for a specific project. Risk is defined in financial terms as a chance that an outcome or investment actual gains will be totally different from your expectations or from the expectations of the firm. So you expect something, you put your target. However, when it comes to the reality, it does not match with your expectation. So we are mostly, if you put yourself into the financial institution shoes, then you will be saying that that all financial institutions are scared that their expectations will not meet. So it will be downsized. So risk includes the possibility of losing some or all of the original investment that is made in a specific project. So you make some projects, you make this investment. Let's say you do the investment and your investment cost is, let's say, 100 billion or 100 million. And in year 1, in year 2, and in year 3, so in 3 years, you expect some profit, let's say $500, then $300. This is your expectation. This is what you evaluate, and you come up with certain expectation, and $350 million. So this is what you expect, or billion, whatever the case. So when you put some expectation, and when it comes to the reality, the actual things are not matched. Like this is what you expect, and actually, let's say instead of 500, you got 100, or you might even have gotten a negative number. You've got, let's say, 50 here, and so on. I mean, this is what you're afraid of if you talk about from the perspective of the financial institution, so that this is the risk that you don't want to happen. So what is the main goal of the financial institution, guys? What is the main concern? Not the goal, yeah, let me put it in a correct word. The main goal, not only the financial institution, of all organizations that exist, any businesses, what is the main goal?
To get profit.
Yeah, to maximize the profit, to get the profit. So let me just profit. So this is only the thing that the firms, the businesses, organizations, doesn't matter what type of field, which type of the industry they are working in, the main aim, the main objective is to earn profit. This is the only thing. But if the expected numbers are not matching with the actual numbers, I'm talking about like downgrading numbers, like in here we expected 500, but we received 100. Really, it will make us upset. But if you receive 1,000, if you receive in here 5,000, of course it will make you more happy that you expected less, but you received more. But in reality, it doesn't work like this. In reality, most of the time it comes like with a worst scenario, you lose the money. So basically what you're afraid of to lose this invested money, this invested original of money. So in a certain project, like you are trying to invent a certain financial product and you want to see how it will go in the market, and you put a lot of money in it, but when it comes to the reality, there is no demand on it. Imagine you are working in a financial institution, in a marketing department. Now your job to create a new financial product. Financial product. You do all the cost evaluation to produce that financial product. You come up, let's say you said, in order to come up with this financial product, in order to advertise it, in order to offer in the market, you have to invest maybe 800,000 bucks. So as a financial manager, you approve it, but you take the responsibility. And what is the thing that you are concerned? What if this financial product will not be successful in the market? What if there will not be any demand for this financial product? It's a unique financial product, but what if nobody will come with it? What nobody will want this? Like, put yourself to the shoes of the financial institution management. You invest this money because to advertise first of all, you need to advertise. The advertisement cost is one of the expensive way of getting your product to get to know to the people. Like, you can make it internet, other things, and billboards on the road so that people get to know it. I can give you the example. You can, when you drive the car, you can see that Kaspi or Halyk Bank or any other banks, they offer different financial products like credits, like a loans, come and get it, or loan and you will get a house, or the mortgage loans, something like this. So they spend money on this, and the money that spent is not small. So when they spend it, they want it, of course, to have some positive feedback. They want to have some positive results. They don't want to lose the money that they invested. So this is the risk they are concerned. And the risk is coming from different ways. First of all, they think that the profit they earn will be affected in a different ways. The first way they say is interest rate risk, because the interest rate risk will reduce it. Why is the first? Why is not the market one, or credit risk, or off-balance sheet? The interest rate risk is the first because the interest rate is the way from which the banks or financial institutions, they earn money. This is the way. They're afraid of it, like if there's an interest rate risk, if interest rises, if interest rate falls. So they want interest rate to be stable rather than increasing or decrease. But in some cases, they won't increase. In some cases, they won't decrease. So in what cases we will discuss it, and in what cases they're going to get benefit, in what cases they're not going to get any benefit from it. So we're going to discuss this whole stuff. And we're going to discuss this type of all risk briefly in this chapter. But coming from the next chapter, we're going to discuss them in a detail, like each interest rate risk, market risk, credit risk. We're going to go with a detailed explanation. We've got off-balance sheet risk, technological and operational risk. Basically, technology and operational risk, they're somehow interconnected. Foreign exchange risk, country risk, liquidity risk, and insolvency risk. Look, it starts with interest rate risk, and it ends up with a insolvency. Insolvency refers to bankruptcy risk. Like, you start with the interest rate risk, you can end up with a bankruptcy if you do not take into consideration this type of risk. Before 2007, 2009 global financial crisis, that the movie that you watched, they faced all of them, let's say 90% of this risk. All the financial institutions that had a problem during that global financial crisis, they faced this risk. Now they learned a lesson from that, and of course they are now more organized. So when it comes to the interest rate risk, actually it has been divided into two parts. One is refinancing risk, the other one is reinvestment risk. So reinvestment and refinancing. So interest rate risk is divided into two parts, refinancing and reinvestment. The risk which is incurred by interest rate risk is when financial institutions assets and liabilities maturities are not matched. So the picture, the ideal picture of having ideal structure of balance sheet for the financial institutions, they should have assets and the liabilities in terms of maturity more or less the same, in order not to face any problems, any risk. The risks that are related to interest rate risk, these are the refinancing one, the other one is reinvestment. Okay, let us talk about the refinancing risk. Refinancing risk, or it is called as short funded. This is the risk where the cost of rolling over or reborrowing the funds will rise above the returns that being earned on asset investment. So let me give an example to clarify this definition. Let's say you borrowed, so we said the banks, how do they work? They collect the deposits and they give a loan. The difference on interest between deposit rate and lending rate, this is how they earn the money, net interest margin. Lending and borrowing rate. So when they borrow the money, the banks, when they collect the deposits, they give some interest to the depositors. Let's say they promise 3%. But they borrowed for 1 year. The maturity is 1 year, okay? They borrowed for 1 year. They say within the year, we're gonna return it back, but with a 3% interest. This is the bank. And the collected fund, they provide to the customers as a loan, okay? Customers. And they provide the loan, let's say for 2 years. Now, there is a risk arised. The maturity is the number of the years the funding is provided for. So deposit was provided to the bank for 1 year, and banks collected deposit gives as a loan to the customer for 2 years, but let's say at 5%. Good, they earn 2% of profit. That's perfect. But within the year, let's say 1 year passed. 1 year passed. That means they have to find another depositor for second year, because the loans they got from the first depositor, they already provided as a loan for 2 years, and the rate is 5%. Imagine if the interest rate in the market rises to, it becomes not 3 but 7%. What happens? What kind of risk they may face, do you think? Is it they're going to benefit, or they're going to have some loss?
So bank will experience 1% loss.
How much money they're going to experience, we're going to come up with this to calculation, but I want you to understand the logic. They lent at 5% for 2 years. But after 1 year, they realized the interest rate rose to 7%. The cost of borrowing increased. That means the money they have lent to the customers, they lent it at lower rate, but now they are borrowing at higher rate, for the second year. There is a loss. And we know from the definition that bonds, if you remember, if you go to the bond market or debt market, let's talk about the debt. There is an inverse relationship between the interest rate and the bond value. This is another story. We're going to talk about the market. This is market risk, okay? The value is totally different. Now we're talking about the interest. So whenever you lend it, the problem is in here. You lend for 2 years, but you borrow for 1 year at fixed rate. But next year, you have to reborrow the money. When you reborrow it, you're borrowing at higher rate, but it seems that you lend it at lower rate here. But you're borrowing at 7%. So your loss will be not 1%, but around 2%. But we can calculate, we can come up with a gap maturity that will give us a clear picture. So this is what the banks are less desiring to have the situation when the assets maturity is higher than the liabilities. So liabilities are deposits for the banks, and the assets are loans for the banks. So if it was the vice versa the case, then the banks was happy to, in this case, what is the benefit the bank will get if interest rate goes down? Then the bank will benefit, because banks now has got an access for lower cost of borrowing, but he's lending at higher rates. So he lent the money at higher rate. So the purchasing power of the money that he has got, the profit he's gonna get it, will be higher, because these guys are paying the interest. The interest that received will be higher, and that received interest can be relended to somebody else at higher rate. So in this case, the bank will benefit only if interest rate falls. But if interest rate rises, the bank is going to suffer, because the maturity of the asset will be higher than the maturity of the liability. This is, the banks are less willing to get actually this position. Okay, coming to the reinvestment risk, it is the risk, the returns on funds that to be reinvested will fall below the cost of funds. So this is the opposite situation to the previous one, where the liability has got higher maturity and asset has got lower maturity. In here, interest rate reduction will make the bank to suffer. Why? Because they borrowed, let's say, at 7%, and they lent for just 1 year at 5%, at 8% at the beginning. Then when the interest rate falls, however, they borrowed for 2 years and they lent only for 1 year. If interest rate falls to 4%, that means whatever they borrowed at higher rate. If they didn't borrow for 2 years, if they have just borrowed for 1 year, they could have really made a good money on that. Now they could have an access for the loan at 4%. But if the interest rate now is 4% and they are still paying 7% in the market, they are overpaying 3% to the cost of borrowing. But for 1 year, for the coming year, that means they will have to lend at 4%, or not 4%, but at 5 or 6%, higher than the cost of borrowing. But it will not be higher than 7%, because if they put higher than 7%, they can put higher than 7%. But what is the problem, guys? If they put, let's say, here, if they say, let us put it was 7, then it becomes 4%. But when it was 7, they lent at 9% for 1 year. But in the second year, what amount do you think can they lend the money? Can they lend the money at 9% in the second year? Can they put this money, the interest rate, as a bank, not to lose? Because they borrowed at 7% for 2 years, and for the second year they have to somehow compensate that. But the interest rate falls to 4%. Do you think that the bank can put 9%?
No,
Why?
because central bank would not accept that. No.
You know, we're in a capitalistic system. It's not like communism. In capitalism, everybody is free to charge any interest, like free market.
No one will buy it. No one will take it because on market interest is different.
Very good. Thank you so much. Yes, the bank can charge this interest, but nobody will come and take the loan from you. Nobody will come and buy this financial product from you, because why they should go, let's say, Kaspi Bank charges 9%, decided to charge, but there is another bank, let's say Halyk, charge it 5%. So which bank would you go to, Kaspi or Halyk? This is Kaspi, let's say, and Halyk. Nobody.
Halyk.
Definitely everybody will go to Halyk, because the Halyk is giving you 5%. Why you should go and pay extra money? Why you should go and pay extra cost for borrowing the money? So you will choose which is lower. Any type of products, anything. So we are in a free market. Nobody can force you to buy something. Nobody can force you to sell something. Whatever you do, you will have to, you are having an alternative way always. So there's a competition, and you will choose which is the best for you as a customer. So this is the situation where the banks are less willing to have as well. So in here, they will be willing to have increase of interest in the reinvestment risk. But when it comes to refinancing risk, they are willing to have reduction of interest. Okay, this was the interest rate risk. Talking about the market risk is the risk that is incurred in the trading of the assets and liabilities due to the changes of interest or exchange rate or other asset prices. So a FI's trading portfolio can be differentiated from its investment portfolio on the basis of time horizon and the secondary market liquidity. And trading portfolio contains basically short-term assets and liabilities and derivatives that can be bought and sold quickly, where the investments have long-term, they are relatively illiquid. They are kept actually for until they mature. Example are bonds for 10 years, for 25 years, 30 years. So this is the type risk that the bonds may face. For example, you're a bank. You can buy with different purpose. You can buy with to resell it. You can buy with to keep until maturity, like holding until maturity. Let's say you bought the securities, the trading for liquidity position. So at any time you can resell it to make some markup, to make some profit. And there's a T-bills or T-bills. There's an inverse relationship between the bonds or T-bills. As interest rate increases, the value of that security will fall down. So this is what you're less willing to happen in this case. Or it can be bond, it can be anything. So as the change in the value, as there's a change in the interest happens, you're not only thinking about the maturity of your asset and liability, like current asset and the current liability. Now you have to think about the value of the asset that you have in that, or in liability that you have it in your balance sheet. One side, the maturity affects, on the other side, the value will be changed due to the market risk. So this is what we say is market risk. As the interest rate changes, the value of that holding asset will change as well. That will be less willing to happen actually. So it can be the case that your liabilities are more than your assets. I mean the current liabilities in terms of having this asset, and in changing in value. Let me give you an example more clear. Let's say you have assets of 300 of, let's say, bonds that you sold, and you have liabilities of 500 bonds. If interest rate, let's say, increase, okay, this is your bonds, this is the this is where you issue your bonds, okay, to collect the money, and this is where you buy the bonds. This is the example. If interest rate rises, and we know there's an inverse relationship, the value of the asset that you hold and the value of the liability that you hold will be going down. So in this case, you will benefit because you are having less of bonds depreciated than you are having liability depreciated in terms of value. So this is that you're more concerned, actually. And I can give you the example with inflation related to interest rate, how the inflation affects, actually. So, as interest rate increases, that increases the cost of borrowing. Of course, then we expect to have higher inflation, actually. How the interest rate is counted with the inflation. So there's a kind of positive association between inflation and the interest rate. So when the inflation is high, I mean, your currency that you hold is losing its purchasing power. Imagine, put yourself into the shoes of the banks. You lend money as $100 to a customer. The customer, now let's say, who can tell me how many days you can live for $100? Now. Let's say you can live for 2 days, okay? You can live for 2 days for this $100. You can live for 2 days. You lend this money to the customer for 5 years. In 5 years, this $100 will be equal, because of the inflation, everything became very expensive. You will be able to live just for 1 hour. And of course, as the time passes, the salary increases and so on. That will make, let's say in here, if you used to earn $200 as a borrower, you're in the shoes of the bank, guys, don't forget. And this is how much you used to earn as a borrower and pay the salary. So you used to pay half of the salary, but after 5 years, you will earn, let's say, $400. So it's just 25% of salary. So after 5 years, to pay this debt will be much more easier for you rather than paying today, because today there is no inflation and you can live for 2 days. But with this $100 after 5 years, you will be able to live 1 hour. So, and your salary will be $400. For you, it will be much more easy. But for the banks, when they receive this $100, actually, they will receive less in terms of purchasing power, because they will be buying less now. So this is the risk they face it actually when the interest rate changes. It affects a lot the inflation, it affects the value of the asset they have it, or the liabilities they keep it actually. This we call interest rate, market risk. So another example is here, like bank is 200-year-old British merchant bank failed as a result of trading losses in February 2005 because of the aggressive trader Nick Lesson, who invested in Nikkei stock market heavily, and bank lost $1.2 billion in 1 month. So this bank was kind of not a bank, it's a financial institution. They kind of were suggested to invest in this stock market, and they, because of the market risk deteriorated due to the interest rate changes, they lost $1.2 billion in 1 month. Credit risk is the risk of promised cash flows from loans, and securities that held FIs may not be paid fully. So the example that we watched 11 minutes movie last time, it was credit crunch, where the banks have provided their credits and loans, and the first thing that they're concerned, even yourself guys, when you lend the money to your friends, the first thing that comes into your mind is when this guy is going to return my money back. When my money will be sent back. This is the first thing that you more concern actually when you give the loan to your friend. The same thing with the bank. When they provide the loan, first risk they consider is what happens if he doesn't pay. We have to check the legitimacy of his financial history background. Otherwise, if he fails, we're gonna have problems in that. So let us just think of it, how to make it more curiously. So the risk actually, the credit risk can be divided into 2 parts. One is like firm-specific risk, the other one systematic risk. When it's a firm-specific risk, that means that the company can take into control. But when it comes to the systematic risk of credit, it's not in the hands of the financial institutions, that they cannot control if anything happens in the market. So what could be done actually to put yourself into safe side? Most of the financial institutions, they experience this and they use it. It's diversification methodology can be used. Like, don't put all the eggs into one basket. Just use 2 baskets. If one basket falls and all eggs like collapse, then at least you will have a second basket to compensate. So when you provide the loan, provide for different group of people, like for corporation, for people. Do not provide for, you should segment your market. You do segmentation, divide your lending industry into different groups, and you provide in this way. If one of the group fails to pay the back, at least the second group will be able to pay. So in this way, you will kind of diversify yourself, kind of secure. With this diversification, you will reduce the firm-specific credit risk, but you cannot affect the systematic credit risk, which is coming from the market, which is uncontrollable. Okay, everybody knows what is the balance sheet. It's just a question, asset equal to liabilities plus owner's equity, but there is off-balance sheet items. This risk occurs by financial institutions due to the activities that are related to contingent asset and liabilities. So there are some contingent asset and liabilities like letter of credit, loan commitment, derivative positions like forwards, future, and swaps. So these are all activities that are held before they realize in the off-balance sheet side. Once they are realized, once they are taking place, they move to the on-balance sheet side. So we will study this as well. This is very important because you don't know, you cannot see on the balance sheet, you can see the, to see the liquidity. Everybody knows how to measure the liquidity easily. It's like current asset minus current liability. If the current asset is more than current liability, it shows that the banks are liquid. But you should not forget there are the activities that are off balance sheet, and they will become on balance sheet. You should take them into consideration as well. And this example of the off-balance sheet activities like letter of credit, loan commitments, and derivative position. So we're going to talk about letter of credit. I think you should be familiar with. Anyone who can remind me what was the letter of credit? Okay.
Letter of credit is when some bank has agreed in advance to give a loan to some company without any procedures.
It's like a guarantee.
Yeah, yeah. And it is used in which cases? In which cases they are used?
When suddenly company needs money, they use this line of credit and now they have a liability.
Perfect, perfect. But let me remind, what about the trading between two countries, export and import? Are they using this?
It's a guarantee that the payment will be in the right amount in the right time, like this.
So they're using this in the case of export and importing. Okay, good. What about the loan commitment? Have you heard about it? Okay, let me just explain. Loan commitment. Let's say you are given 10 million, but you are given up to 10 million. Now, Halyk Bank gives you, if you go to Halyk Bank and if you are working, for example, last time they called me, they said we can give you up to 10 million, the loan. So let's say for 5 years, okay? So within 5 years, let's say that means I'm able to get only 10 million, let's say. But they said you can borrow now 4 million. The rest 6 million you can borrow at any time that you want it. Like you can borrow here, 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 but maximum amount that I can borrow should be 10 million. So from 0 to 5 years, within 5 years, I can borrow 10 million. If I borrow today 4 million, that means I have availability of 6 million for the remaining 5 years. So I don't have to go to the bank and apply and anything. I just go online and just apply online and get the remaining 6 million or 2 million. So why the banks, they should be afraid of it, like of this 4 million or remaining 6 million? So that means that if loan commitment is given to the customers, we're going to discuss a bit more about it. If I got 4 million and I can withdraw 6 million at any time I want within 5 years, this creates the risk of having liquidity position for the bank. Imagine there, let's say 100 customers and all of them decided to withdraw this 6 million. The company may face a liquidity problem. They will be facing they may not be able to meet the demands on withdrawals. So this creates a problem. So this 10 million, I don't have to borrow, but I may borrow. Nobody's obligating me, but it obligates the bank to pay the loan. So the bank cannot say, okay, we cannot give you the loan because they already signed the agreement. I will get this 10 million, but I will get to the 4 million. The rest 6 million, I may want to get at any time, but I may not get at all. So this is actually creates a problem. If I get this loan commitment becomes on balance sheet, and it may affect as well. That's why it is called like off balance. The same thing with the letter of credit. They give you guarantee. If something goes wrong, the bank goes as a backup, as you said. If the bank goes as a backup to pay that liability side for the customer, then this letter of credit becomes not an off balance sheet, but it becomes an on balance sheet. That will affect the position of the company. So it's actually it's under the dangers. So the same thing with the derivative positions like forward, future contracts and swaps and the options, warrants, we can add it in here. They're all in the off balance sheet side. Okay. Technology and operational risk. The major objective of technology expansion is actually to reduce the operating cost and increase the profits in the future. Technology risk occurs when technological investment actually they do not produce whatever you expected and whatever you anticipated, the reduction in the cost. And you do not, actually your aim was, you should remember from the economic course, like economy of scale or economy of scope, like all the organization, all the firms, they are trying to reach economy of scale, which means that less input, more output. By less input, it means less cost of producing something. So when you introduce a technology into your company, you're doing it with the purpose to reduce the cost. Put yourself 10 years back. Compare how much crowded the bank was and now how much the bank is crowded now. Nowadays, do you go to the bank to pay the bills? Like electricity
No, we
bill,
can
water.
pay through the app.
Yeah, the app is available, technology here. So you don't have to go and waste your time in waiting the queue. You don't have to go and just attend the physical location. So if there is no need for you, it means if previously 10 workers used to work in the tellers, then it means now that 10 workers are reduced to 2 workers. Because now the cost is reduced for you. Don't pay for workers extra, you don't pay for electricity, anything. Everything is done by technology. But of course, it works if it's installed correctly, if it's installed on time and efficiently used by workers. But however, if you install some machine to reduce the cost, and if you install something but still keep hiring the workers, still doing like these bureaucratic processes, that will not get you to the place that you actually wanted to get at the beginning. So your anticipated cost saving will not take the place. Instead, it will just come up with a more wasting. Or another thing that you installed computer machines in your let me give you an example, another one, like Citibank in 2004, if I'm not mistaken, for just, I think, 4 hours, the ATMs did not work. They incurred a huge loss, very huge loss. And like 2 weeks or 2.5 weeks ago, I had participated in one conference. In that conference, my colleague, he presented one very good research. He made it actually himself. He found it out that if you cut the internet for 2 hours, cut the internet, imagine the country without internet for 2 hours, Kazakhstan. It happened in 2010, I think, he said. In 2010, the internet was absent for 2 hours only. Because of that 2 hours, the whole financial system incurred the loss of $2 billion. The loss happened for $2 billion. So the internet was not available for just 2 hours in the Kazakhstan. He said about the Kazakhstan. I'll try to get for the next class his research. I'll share with you. So this type of technological and operational risk, they're interconnected. So the technology, you install it, if it fails, you will have an inverse effect. Financial institutions, for example, they heavily invest in derivatives and stock market. For example, when I used to work in Cyprus, in a financial market, we used to invest in options and call options and put options in Japan stock market. And we didn't analyze anything. We did not like wait for the time to sell and buy something. We just relied on the computer system. We just leave the computer system open and it buys and sells itself. Like it was like algorithm programming was written by programmer, and the operational, like we were given some limit orders, limit to buy, limit to loss, and so on. Imagine if this collapsed for 1 hour, 2 hours, what could happen? What could be the loss for the company itself? When there was a time to sell, but it did not sell because the computer was failed, computer system. Or when the time was to buy, because there was like the value of the assets reduced and you could have really gained a good money on it. And the computer that time was broke and failed. This loss that company could have experienced actually. So any technology install, if your anticipated cost saving doesn't come true, then you do not experience economy of scale, but you're going with this economy of scale. Okay. Apart from all the risk, there's another risk. Guys, please tell me if there's time. I'm not just. We still have time. Great. I thought we were running out of time. Okay. Foreign exchange risk is the risk the exchange rate changes that affect the value of an asset and liability. This is you're mostly familiar with actually. All people who live in a developing countries who have their own domestic currencies, when the domestic currency is depreciating or appreciating, it affects a lot. So the banks as well, because nowadays all the financial institutions are globalized and they are interconnected globally. If anything changes in the value of the currency, it affects the transaction. So the cost of borrowing changes, everything changes once the currency is appreciated or depreciated, because somehow the currency is affecting all the aspects of the industries in the country. So FIs, if it's fully hedged against exchange rate risk, they hold the same amount of foreign assets and liability for exactly the same amount maturity. So for these days, we've got that financial institutions, like they're obligated to hedge against foreign exchange changes using the forward and the future contracts. Apart from this foreign exchange market risk, credit risk, and so on, there is a country and sovereign risk that results of exposure of foreign government, which may impose restriction on repayments or to foreigners. Something that is not coming from the control of the risk, such as credit risk or market risk or something not related to the financial market. Who can give me any example of nowadays that we are facing this risk? Nobody ever expected to happen this, but it happened and it affected a lot the market. Consequences still we have not seen it yet. It's pandemic coronavirus that we are facing nowadays. Or it can be a war, it can be, let's say, the system of political the country is running. It can be very tough for the businesses to run. So it can be too much bureaucratic and you cannot just, as a foreigner, you cannot go and work there. If it's not stable, who can tell me, let's say, I'm sure that you heard it and you read it. If you're an investor, and which country would you go? Turkey or, let me just give you an example of the country, or Djibouti. There's a Djibouti country, there's a Turkey. Which country as an investor would you go to invest in?
Turkey.
Turkey. Why? Because you think that the Turkey is more stable country in terms of political issue, but Djibouti is one of the like north part of the Africa, and the politically is not stable as Turkey is stable. But nowadays Turkey is not really experiencing good thing, but still is more stable than this country. So the stability of political system, it affects your choice as well. And all the financial institutions, they think before going to that country or before investing in that country. Liquidity risk is a very popular risk that the financial institutions like they're facing, and this is the cannot be ignored. And it happened in global financial crisis. due to the subprime mortgages, the first thing that happened in the global financial market, that all the financial institutions, they faced the liquidity. They didn't have enough money. They couldn't find the source of borrowing. And everybody was scared if those people of those companies who had the cash, who had a budget, they were scared to lend it. If they lend, but they lend at higher rate. So everybody's scared during the global financial crisis to lend the money, and it was really very tough time for the financial institution because they faced the liquidity. There were high demand on withdrawals because people, they went into panic, and the people wanted to withdraw all of the monies. And you know, like word of mouth, how it works. If you hear that the bank is not capable to give the money, you will just go and say your friend, the friend sell to your relatives, and so on. Like, this chain will work in 1 hour, and everybody will be aware of the banks is having some difficulties. And at the end, if this liquidity problem is not solved and cannot be fixed out within a shorter period of time, the financial institution, they're afraid of facing the insolvency risk, the risk of insufficient capital to offset a decline in the value of the asset and liabilities. Like a huge amount of the money was declined in terms of value, like because most of the financial institutions, they are dealing with the long-term assets and long-term liabilities, loans and debts. If there's a sudden decline, it may lead to the insolvency risk, to the risk of the bankruptcy. Okay. This is all I wanted to discuss. If you have any questions, next class, we're gonna proceed with calculations for this, related to this chapter. We'll solve some practical questions, and you'll get better each risk. But apart from that, we're gonna have each chapter, each risk separately studied actually. If you don't have any questions, it was.
Excuse me.
Yes, please.
Where we can find the record of this video, like of this lecture?
Okay. Let me go to here in Moodle. I put it. This is our course, Financial Institution Management. So for the previous lecture, here the video 1, Introduction to Finance. You just press
Okay, I got it.
So today I'm gonna put it under this lecture, our video.
Okay. Yep. Thank you.
Okay. If you don't have any questions, thank you so much. See you on Monday.
See you. Have a good holiday.
Thank you. Goodbye.
Goodbye.
Have a nice
Thank you.
weekend, guys.